Hello and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Brand new week and the cues, at least this morning, are looking a little positive. But of course, not to forget that we are coming off a 5 straight week of losses for the market. Not a great place to be. Longest losing streak in 2 years for the Indian market. Of course, lots to digest. We have the August 7 date when the 25% tariffs kick in. That is starting today, and the outcome will be declared on Wednesday. And we also have a whole host of earnings that will be coming out this week. So lots to digest this week. It has been a turbulent last few weeks for the market, complete bearish outlook from experts as well, and of course consistent outflows from the foreign investor community as well. The GIFT Nifty this morning hinting at a positive start. The markets in the pre-open are looking mildly higher, around the 24,600 mark for the Nifty. But of course, a lot of result reactions as well in focus today. The likes of Federal Bank, the likes of ITC. We'll see how those stocks react to their earnings as well. But before we move any further, quickly take a look at the top headlines at this hour. Wall Street ended Friday's trading session sharply lower on the back of a weaker than expected jobs data and Trump's revised tariff rates. The Dow tumbled more than 540 points while the Nasdaq slipped over 470 points. Asian markets are off to a mixed start as investors assess latest round of tariffs and a weak jobs report from the United States. The GIFT Nifty higher this morning, and in the pre-open we are looking fairly positive. Crude oil prices slip after OPEC Plus agrees to another large production hike in September. Brent trades at $69 a barrel, while gold prices rise as weaker than expected US payrolls data boosts rate cut expectations. And in key earnings, FMCG major ITC reported a mixed set of numbers. Revenue beat estimates led by cigarettes and agri-businesses, but margins see sharp contraction owing to leaf tobacco inflation and weakness in the paper business EBIT. And the RBI's policy meeting begins today. The committee is largely expected to hold rates this time. The rate decision will be announced on Wednesday. Well, quickly take a look at the cues this morning. The markets, of course, saw 5th straight week of losses, longest losing streak in 2 years. More than 35 Nifty stocks posted losses last week. Both Sensex and Nifty fell 1% each. The Nifty Bank and mid-cap indices also, shed somewhere around 2% apiece. Except for FMCG, all sectoral indices slipped. Realty, defense, metal, these were some of the top losing indices. You look at some of the numbers or some of the companies that didn't do all that well. Kotak Bank, Adani Enterprises, those were a few. But HUL on the other side and L&T were among the Nifty gainers on the back of good numbers. But PNP, Housing, IFL Finance, Indus Towers, these are some of the top mid-cap laggards, whereas Keynes Tech, Amber, all those companies did well. We did, of course, break out of the trading range on the downside. We violated the 24,600 mark that was being pegged as a crucial support level for the Nifty. Of course, we'll have to see whether or not 24,500, that is the next crucial support level, that gets broken. If that happens, 24,200, 300, those are some of the levels that experts say cannot be ruled out. In terms of the foreign investor flows, as I mentioned, they have been consistent sellers in the Indian market. The net sell figure stood at 3,300 crore rupees for FIIs, but DIIs continue to buy with 3,186 crore rupee worth of buying in the cash market. But let's get on board our expert then. Without any delay, joining me is Ajit Mishra of Religare. Ajit, great to have you on the show. 24,600 taken out. What do you think? Where are we headed? Given the fact that the GIFT Nifty is hinting at a slightly positive start, do you think those won't sustain and we will see selling at every bounce?
Yeah, good morning, Nandita. So, Nandita, 5 weeks of successive decline, no respite. A common pattern means if you see that the initial 3 days market witnesses some consolidation, in the final sessions, Thursday, Friday, we resume the decline. So now, like what you have just shared, 24,600, the 100 EMA mark is something that Nifty has breached on Friday. So it's not a good sign. Definitely, it's not a good sign despite, this successive 5 weeks of decline. So what this indicates is that bears are completely under control, and now 24,450. So basically, this area was the lower band of the previous consolidation zone, which Nifty was holding strongly. So we expect this area to respect, but for any meaningful recovery or a rebound, we need to surpass 25,800, 24,800 decisively. Then only you can make an attempt towards 25,000, 25,100 mark. And for trend reversal, we need a close about 25,250. So it's a long way to go when it comes to recovery. Good part is that the oversold positions are there. FI's long short ratio is also at the substantially low. So these factors may result in bit of a recovery every now and then, but for any sustained move, we need to reclaim 25,800 mark. The most challenging part now is that earlier we were, So just to add to what, So just to add to what, earlier we were falling from our own weight. Now with this fresh decline in the US markets, that may further result in some pressure is what the indications are. So keeping that all in mind, one should still maintain cautious approach when it comes to the index and not to get carried away with any intraday, bounce until we decisively reclaim 24,800.
24,800, that is the crucial level on the upside. Unless we conquer that level, setup looks fairly bullish. But what about Nifty Bank Index now? Ajit, 2% cut last week. Also, the mid and small cap indices have small caps were anyway underperforming. The mid cap index 2 weeks in a row, I think it has underperformed the benchmarks. Your thoughts on how the mid caps are poised and the Nifty Bank Index as well?
So Nifty Bank, if you see that only SDFC and ICICI, the two heavyweights are trying to hold the ground, and that's the reason why we are seeing intermediate bounce every now and then. But since the index has slipped below its short-term averages, possibility of further decline seems high in banking too. So now 54, 500, 700 is a zone basically where we have the next major support around 100 EMA. And in case if there will be any recovery, 56, 500 will act as a very strong resistance. So as of now, the look, outlook for banking also look sideways to weak. But yes, comparatively, if I compare it with the Nifty, it's still better. Broader indices, on the other hand, they've started seeing decline after a period of outperformance. But it slightly looks oversold to me. So we might see some respite in mid cap and small cap. But again, one should not be jump into a trade. Basis that rebound, one should only focus on the companies or the sectors wherein we are seeing decent earnings. And the price action is accompanied with volume. So as of now, since the tone is negative, one should be slightly cautious in mid cap and small cap space too.
Okay, setup for Nifty Bank Index looking better than the index, and mid and small caps could see some recovery going forward. Just about 19 seconds to go. I really wanted your thoughts on a couple of stocks before the market opened. So very quickly, PNB Housing. That's one stock that saw almost an 18% cut, biggest fall in 4 years. Major breakdown, and how would you look at that stock, PNB Housing?
So yes, after this decline on the basis of news, we may see some respite or a pullback. But overall, one should not just start catching the falling knives. Let the stock consolidate, and then only you should look for any fresh long ideas.
Okay, that's the view on a PNB Housing. Let's take a look at the market open then. First ticks coming in, and it is positive as we had expected, given the fact that the GIFT Nifty was indicating a positive start for us. So the Nifty well above that 24,600 mark. So that's the reprieve. 60 points uptick on the Nifty. On the Sensex as well, it's a 185 point bump up. The bank Nifty as well trading with a positive bias. Look at the mid cap index, that's also moving in tandem with the benchmarks as of now. And early days to really comment on the breadth, but as of now, needle is of course tilted towards the gainers. So the NSE advanced decline ratio right now is almost 2:1, and the list of gainers and losers on the Nifty. Looking at that, the list of gainers is longer than the list of laggards. So that's another reprieve. But let's take a look at the sectoral picture then. As I mentioned, the Nifty Bank Index trading with a positive bias. Last week we only had the FMCG pack that ended the week in the green. All the other sectors saw steep declines, the likes of realty, defense, etc. This morning we are seeing green ticks almost across all the sectors, barring IT that remains under pressure. Last week as well, the IT pack was under pressure. And media pack is under some bit of pressure. But aside of that, all the sectors are trading in the green. You have the likes of auto up 0.3%, FMCG extending its gains, metals up, pharma mildly in the green, PSU banks are up 0.5%. Realty is also limping back, just about flat, but with a positive bias. In terms of gainers on the index then, let's take a look at which are the stocks that are doing well and keeping the index afloat. The likes of Bajaj Finserv, that's the top Nifty gainer, Tata Steel, Bharat Electronics, Shriram Finance, IndusInd Bank, that has been a laggard in recent times, is trading with a positive bias. Bajaj Finance in the green. Trent, that reports numbers this week, trading in the green. Jio Financial, HUL, Adani Ports, Asian Paints. Bajaj Auto also reports numbers this week and trading in the green. But on the other hand, what's not doing well is Eternal. That's the top Nifty laggard, but losses are just somewhere around 0.5% or so. Infosys, HCL, Tech Mahindra. So some of these IT names continue to be on the laggards list. ITC has slipped into the red. It had a positive open. It has reported a mixed set of numbers and the stock is sideways at best right now. ICICI Bank and Kotak Mahindra Bank also under pressure. Kotak Mahindra Bank, remember, has been under pressure ever since it reported its numbers. But Kotak Mahindra Bank on the charts, I know we spoke about how ICICI Bank and HDFC Bank, these are some of the stocks that are lending support to the Nifty Bank Index, but particularly looking at Kotak Mahindra, what has been your stance on the stock, especially after numbers?
Ananta, post numbers, we saw this sharp decline, followed by a very tight range consolidation around the long-term averages. But still, the tone looks negative to us. Means if the short-term bias may witness further strength once we slip below 1970-75 area. So we are very close to that mark. So one should not look for a fresh long position until we decisively reclaim 2000 levels, 2010 on Kotak Bank for any recovery trade. Means once, let's say, we cross this area, then probably we can see an attempt towards 2070, 2080. Otherwise, the sideways to negative tone might continue.
Okay, that's about Kotak Mahindra Bank. But let's shift focus to ITC that reported numbers post market hours on Friday. The standalone net profit has been pretty flat, below what the street was estimating. Revenues were up 20%, that was slightly above expectations. But margins at 31.7% vis-a-vis 37% on a year-on-year basis came in as a disappointment. In terms of cigarette business, the revenue growth was at the revenue was at 8,520 crore rupees vis-a-vis 7,900 crore rupees on a year-on-year basis. The cigarette volume growth was much better than what the street was anticipating, around 5.5 to 6% versus estimate of 3 to 4%. And in terms of the agri business, that also did pretty okay. Paper business, that has been a pain point. Analysts believe may have bottomed out. In terms of brokerage views, they are fairly positive. Citi has a buy rating, target price at 500 rupees per, and they have taken a note of the fact that cigarette revenue grew 8%, and they've also said that margins are under pressure due to high cost leaf tobacco, and that is likely to persist in FY26, throughout FY26, so to say. Paperboard segment remained under pressure, but most analysts say that it may have kind of bottomed out. Any targets, Ajit, in terms of ITC? FMCG pack has managed to hold its head above the water. Do you expect that to continue? And in the current scheme of things, do you like ITC better or HUL better? Because HUL as well, we saw some bit of volume-led recovery in its quarterly numbers.
That's true. And Nandita, the way HUL recovered and the kind of volume that we are seeing, probably we can see the further move or recovery to continue in HUL, with 2500 being the immediate support area. So here, gradually we can inch toward 27,000, 2700, 2750 area. So yes, here the risk reward is comparatively favorable. ITC seems like still stuck in a range. So until we break 425 decisively, I doubt that we can see any meaningful recovery. On the downside, 410, 405 is the area basically where we have multiple supports. So broadly, this range is likely to play out, but yes, it's also looking positive. But for any fresh momentum, we need a close above 425. Then only we can see a decisive recovery toward, let's say, 435, 440 area in the near future.
Okay, that's about the FMCG pack. One banking stock that I want to draw your attention to is Federal Bank. It reported numbers fairly disappointing. Profit was down somewhere around 15% on a year-on-year basis, below expectations. NII, the net interest income, was largely in line at 2% on a year-on-year basis. Asset quality has worsened slightly. The gross NPA stood at 1.9% vis-a-vis 1.8% on a quarter-on-quarter basis. We have a downgrade coming in on the stock from Nomura. They have downgraded the stock to neutral versus a buy rating. Target price has been cut to 195 rupees vis-a-vis 220. They've cut their FY26 to FY28 EPS estimate by 11 to 13%, as they've mentioned that the reported PAT was 6% below what they were expecting amid elevated credit cost. Now, they are also expecting the returns profile to remain muted in the near to medium term as well. Some of these PSU banks have come under fair bit of pressure. Today, of course, the PSU bank was index was in the green, but over the last month or so, Federal Bank in particular has lost some around 10% or thereabouts. It's very close to Nomura's target of 195. But do you expect lower levels of 170, 172 being tested on this counter going forward?
So, Nandita, I believe that the market was somewhere anticipating a weak set of numbers. That's the reason why, from the record highs from 220 to 190, 95 is something that the stock was already testing, and we've already slipped below the long-term averages. So definitely the trend which we were seeing it earlier, a consistent uptrend, that has definitely dented. So I believe that it's broadly likely to trade in a range after this correction, and wherein 170, 75, yes, is the very strong lower band. So around that area, we might again see the buying interest emerge. So at current levels, in case if you have any existing position, 190 should be your strict stop. Use any recovery towards 200, 203 to exit your longs. And for fresh buying, one should wait for a dip towards 180, 175 zone.
Okay, that's the view. 174, 175 zone, crucial. That's about Federal Bank. But let's talk about MCX as well. Numbers were pretty strong. Net profit was up almost 50%. Revenues rose somewhere around 28% or thereabouts on a quarter-on-quarter basis. The stock is clearly reacting to it. Margins also came in higher by 10%, 64.7% vis-a-vis almost 55% on a quarter-on-quarter basis. The stock is up 4%. But in the last month or so, we have seen a 10 to 11% cut because we have seen some of these capital market plays like MCX, BSC and all these exchange stocks that had come under intense selling pressure. But would you say that today's move is hinting at some kind of a reversal on the charts for MCX? And what are your thoughts on BSC as well, because BSC is also slated to report numbers this week?
Right. So, Nandita, I doubt that we can see a reversal, but yes, a rebound is there because from 9,000 to 7,500 is something that stock was retraced. But if you see the past, surge from 4,000 to 9,000, so still we need some time to consolidate those gains. And short-term averages is now placed at 80-50 area. So until we break that mark, I doubt that we can extend this recovery meaningfully. And upside around 80 to 50, 8,400 will be the area where it has multiple resistances. So as of now, one should not jump into a trade. Wait for a close above 80-50. if you are planning any short-term trade, and then maintain a stop at 7,900 for the positional target of 8,250 to 8,400. And yeah, for BSC, BSC is showing sign of bit of consolidation in a very tight range for almost 2 weeks now, wherein 2340 is the lower band and 2500 is the upper band. So at current levels, indications are mixed. So here again, one needs to wait for a close above 2500 mark to re-enter for any fresh trade. Because in case if it fails to hold this area, then probably we can see the retest of lower band, which is around 2300 mark. And in case if it breaks, then probably we can see fresh leg of decline in BSC. So as of now, it's still, it's in a no trade zone. One should wait for a close above 2500 only to enter fresh.
Okay, that's about BSC. In fact, we had a query on our feed from Pannu Anil on BSC. Hope that answers your query. We will take up more queries in just a bit. Till then, please keep commenting on our feed and sending your queries with hashtag AskMC. We'll get Ajit to answer most of them. But let's talk about delivery before that. The stock is up, reacting to its good set of numbers. Profits were up 67%, revenues rose 6%, margins came in higher at 6.5%, vis-a-vis 4.5% on a year-on-year basis. The stock has been in an uptrend over the last month or so. 15% uptick today as well. It has hit a fresh 52-week high. Would you look at a dash at 500 levels on delivery? Do you think the uptrend is here to stay for a bit?
Nandita, a very strong recovery, I would say that if you see, it's almost a V-shaped recovery post the decline from 420 to 240. And now we have recovered all the losses. We are gradually inching towards the major hurdle area, which is around 480-85 zones. Still, we have like decent upside, 3 to 5% from the current levels. So yes, you can look for fresh long positions with 440 as a stop loss and 480-85 as a positional targets.
Okay, that's about delivery. But let's shift focus to our viewer queries on that note. We have a query from Debu K on Bajaj FinServ. We also have a query on Bajaj Finance from Varsha Gajjar. Wants to know your thoughts. How are you viewing these stocks now with the Bajaj twins? Today, Bajaj FinServ was among the top Nifty gainers. Post numbers, do you think any of these are looking attractive and worth getting into now?
So yes, if you see that the decline is marginal in comparison to what we are seeing across the board and especially in the NBFC basket. And we are very close to the immediate support plus the long-term supports when it comes to the Bajaj FinServ. So 1880, 1890 is a zone basically where we have multiple supports. And in case if it sees any recovery, yes, so it's going to be a gradual recovery for Bajaj FinServ. So if let's say you are planning for accumulation, definitely it's a good time. But from the trading point of view, around 1960 to 1980 could be the zone where it might face resistance. So short term looks sideways to me, but yes, if the planning is, let's say, for medium to long term, definitely you can start accumulating at current levels. Now, for Bajaj Finance, almost similar kind of a structure, but yes, it was outperforming Bajaj FinServ earlier. And currently we are trading in a very narrow range around the medium term moving average. So for any recovery, we need a close above 890. Once we do that, then probably 910, 920 is something that the stock might test. So here I would recommend to be slightly cautious because the texture looks sideways to me with the possibility of further decline or consolidation in days to come.
Okay, that's the view on the Bajaj twins. Hope that answers your queries. But want to take up the next query on a Vodafone Idea. This one's coming in from Pooja Khanna. She's holding shares of Vodafone Idea at 10 rupees a piece. Now she wants to know whether she should average at current levels. Currently at 6.5 or so, 6.7, that's where the stock is at. Would you advise averaging, or would you say one should just take an opportunity and exit from here? What's your take?
So Nandita, definitely I would recommend to exit because there's no point like losing opportunities, especially in a market like this where despite the negativity we are seeing Bharti Airtel, Jio, means Reliance is still holding strong. So in case if the view is to be into a telecom space where uncertainty is still high on the Vodafone side, The prudent approach is to take the loss and shift to the counters wherein we are seeing consistency in the trend. So Bharti Airtel definitely is a better bet in comparison to Vodafone.
Okay, Bharti is a better bet. The call here is to exit Pooja, not to average. Hope that answers your query. I spotted a query from Satvika Ranganathan. She wants to know your thoughts on a Titagar. She has a time horizon of 2 years. Of course, railway stocks, she says, are not trending. But is it worth getting into now? Last 1 month, the stock has shed somewhere around 9% or so, but did see some bit of buying in the last 5 sessions. And today, however, it's up somewhere 3%, somewhere around 3%. So, stock has almost halved from its 52-week highs. Is the risk reward looking better now, or would you say that look at other sectors?
So Nandita, we all know the kind of bull run that most of the railway stock had last year, and especially for Titagarh, if we see that it's been at in 2022 we were quoting at 80, and then we made a record high at 1864 in 2024 June. So this phenomenal move usually followed by a profit taking or a corrective phase, and that is what we are seeing in the stock at present. Good part is that it's still holding the long term averages on the weekly chart, which is placed around 700 mark. But since her view is long term, let's say for 2 years and maybe more, she can start gradually accumulating at current levels with the room to add more till 700 mark. Because probably we can see further consolidation and possibility of downtick also in case if the stocks fails to hold this 840, 850 area. So yes, you can start accumulating, but be gradually in your approach, and definitely you should maintain at least 2 years of time horizon.
Okay, that's the view on Titagarh Rail. But since we are talking about railways, we have a query on a defense stock as well, shipbuilding stock, so to say. Arpan Kar wants to know your thoughts on GRSC. We know GRSC in the last 6 months, has seen a runaway rally, but of course, of late we've seen some of these shipbuilding companies also facing intense selling pressure. Today, however, we have seen a good traction. GRSC as well. Your thoughts here?
So in fact, Nandita, if you see the defense basket, we have seen almost 16% kind of a correction from the record highs, and still there's no sign of decisive recovery. Yes, rebound is possible, and for GRSC specifically, we are seeing an attempt of a rebound after retesting the medium-term moving average around 2400 mark. So for any fresh momentum, let's say once we cross this 2670 area, then probably we can see a rebound attempt towards 2850, 2900 mark. So with a strict stop at 2550, definitely you can consider fresh long positions once the stock crosses 2670 area.
Above 2670, maybe you can look at a GRSC, Arpan. That's the view. But last couple of queries really. There's a query on PNB Housing, Alex. We've already discussed PNB Housing, so perhaps you can go, rewind the feed a bit and check out Ajit's answer. Although he had said that wait for the move to settle down before really jumping in on a PNB Housing. But last query then, this one's coming in on a Nuvama. What's the outlook on the stock for a 1 to 3 year perspective? Query is from Manish Verma. Of course, Nuvama came under a fair bit of pressure with other capital market plays once that Jane Street issue came to the fore. How would you really approach some of these stocks now? Today as well, the stock is under pressure. Worth a look or and avoid, particularly for Nuvama?
Nandita, we all know the kind of rally that most of the capital market related stocks had in the recent past, and now we are seeing a bit of a consolidation, and it's holds true for Nuvama as well. Means the stock has corrected sharply from its record highs, and still we are not seeing any sign of recovery yet. So probably we can see a further dip toward, let's say, 65, 6300 zone, and then maybe we consolidate around that area before making any meaningful recovery. So since his view is long term, I would recommend him to wait and let the stock stabilize around 6500, 6300 zone. Then he can look for accumulation opportunity around that area. Prior to that, one should avoid.
Okay, that's the view on Nuvama. Hope that answers your query. With that, we've come to the end of the query segment. But Ajit, before I let you go, any recommendations for our viewers?
Yeah, so FMCG as a basket, Nandita, we believe that this traction might continue, and from the space, be it Marico, Godrej CP, all these stocks are doing well. So Marico was outperforming the pack earlier also. So we believe that today's downtick or consolidation is an opportunity to go long. 690 is the area basically where we have multiple support. So with that as a stop loss, 750, 760 as a positional target, one can look to go long. In case if you are okay taking risk, then we are seeing fresh breakout in Geo Finance also. It's been outperforming within the space, and we are set for a fresh breakout above the previous swing high with decent volume. So here we can see next leg towards, let's say, 347 to 350 area. So with stop at 324, one can look to accumulate Geo Finance also at current levels.
Okay, that's about the recommendations. Marico, Geo Financial, those are the stocks. With that, Ajit would like to thank you for taking out time and joining in, and that too at a short notice. Always appreciate chatting with you, and I look forward to our next conversation as well.
Same here, Nandita. Thanks a lot.
Thank you. Well, on that note, take a look at what the markets are doing before we get on board our next big market voice for the day. 24,646, I beg your pardon, 80-point uptick on the index. So as of now, we are holding on to the opening gains, and that's heartening to see, because the Sensex is also up somewhere around 200 points. The mid-cap index has gained traction. In fact, right now, as we speak, the Nifty mid-cap index is outperforming the benchmarks, up 0.5% or thereabouts. The advanced decline ratio still in favor of gainers, almost 2:1. That's the NSE advanced decline ratio. And Hero MotoCorp, that's the top Nifty gainer. It reported its auto sales figures for the month of July post market hours on Friday. 21% uptick in sales, and that's why the stock is reacting to that. But on that note, let's of course get on board the next big market voice, Siddarth Bhamre, institutional research head at Asit Mehta Investment Intermediates, joining in this morning. Siddarth, always a pleasure chatting with you. I just want to get started with your thoughts on the markets, because a lot has transpired in the last couple of weeks. And as we know, seasonality is not in our favor. August and September are not really great months for the market. Add to that, we have a 25% tariff that kicks in from the 7th of August in case there is no other deal, any kind of arrangement that we come with the US. Markets, of course, were getting comfortable with 10%, but that's not to be. Earnings have been tepid, no great fireworks. FIIs have been consistent sellers. How are you feeling looking at the rest of the year? 5 months to go, and we are at a 1.5 month low right now. So do you expect the correction to deepen here on?
Good morning, Nandita, and thanks again for having me on your show. Nandita, last 1.5 year, we have seen that markets have shrugged off all negative news and have continued to climb wall of worries. In between, there has been correction which started, in Jan 2025 till April 2025, then again bounced back, and now you're again seeing correction. Now, this means that since last 1.5 year, we are consolidating. And if the one biggest worry which now market faces is earnings, and earnings have not been doing that great. Now, tariff thing also you mentioned, Nandita, already 26% was announced, now 25%. Whether US President would continue to hold on to his words, or whether he would backtrack again. So the way markets reacted to what Donald Trump mentioned or said in media probably 6 months back, markets are not reacting with that curiosity now. So I think that is not the main reason why markets are correcting. Markets are correcting because we are seeing slowdown everywhere. If you look at first from banking perspective, provisions are increasing. Numbers are not coming great from Q1 perspective. And you know what? Q1 was anyways not expected to be great. So expectations were already muted. On those muted expectations, we are seeing that disappointments are happening. So no matter what's happening globally, no matter what's happening geopolitically, stock market's biggest booster or biggest a down tick for a stock market is earnings, and that if starts disappointing, then you would not have great scenario in place. And that's the reason you are seeing in markets high beta names are correcting, defensive names are doing well. So all in all, I believe this market would continue to show this time consolidation till the time earnings don't come up to the mark and try justifying the valuations which we are.
Okay, so in your view, valuations are stretched looking at the first quarter numbers. But do you expect second half of FY26 to be fairly better than what we saw in the first quarter and what we are expected to see in the first half as well?
So earlier, in the sense when we were at Q3 FY25 and Q4 FY25, there was this thing that probably Q1 FY26 may not be that great, and probably from H2 FY26 we will see earnings reviving. But I guess that looks slightly difficult the way things are panning out. So we are not very gung-ho about earnings revival, at least for next 2 quarters. Maybe now we'll have to, look at for great earnings coming in probably from Q4 FY26. So next couple of quarters, I'm not expecting great set of numbers coming in markets. And if liquidity, which is coming into market, that dries up, which in all likelihood seems to happen with a lot of job losses being around. I believe we might see, some pain in markets also in next couple of quarters.
Okay, next couple of quarters, we are expecting more pain according to Siddarth. But Siddarth, in terms of numbers that have disappointed, let's talk about IT. There weren't any great expectations either for the first quarter. But you've been fairly bullish on HCL Tech from the large cap IT name, last conversations on IT that I've had with you. That's the sense I got. It could of course be dubbed as one of the better performers for the first quarter of FY26. But overall, what's the sense? Because even the mid-cap names which showed promise of double-digit growth, they have kind of disappointed. So what are your overall thoughts on the IT numbers that have come out?
Nandita, we were bullish on HCL Tech 1 year back and not, recently. And that is when, when I joined Asit Mehta, we had a couple of interactions and I was quite optimistic on IT and we mentioned HCL Tech as a top pick. But that is some 3 quarters back or probably 4 quarters back we were talking. Last 2 quarters, Nandita, we are not optimistic on IT. In fact, since May onwards, with all the money managers we have been interacting, we have been very vocal that if you want to outperform broader index, you should be long bank Nifty and short Nifty IT. Because we had our own rationals for that. Firstly, at 1% to 3% guidance, and that I'm talking about previous quarter, not this quarter, you cannot trade at 25 times multiple if you're a large cap. Now, when the earnings which were coming at 0% negative or 1%, you continue to trade it at 24, 25 P. Now, historically, it's not that, Nandita, that IT has never gone through this scenario of slight degrowth or no growth. But at that point of time, your TCS used to trade at 20, 21 times multiple, Infosys used to trade at 19 times, and HCL Tech Wipro type of companies used to trade around 15, 16 times. But if you look at, now, before a few days correction, Infosys, TCS both trading at 24, 25 times, HCL Tech around 20 times, Wipro, around 18, 19 times. So valuations were expensive, and time consolidation, if happens, a lot of people would argue that maybe time consolidation would happen. For time consolidation to happen, your earnings should catch up. There should be earnings growth. If earnings are not growing, there is no point of time consolidation. Your stock has to correct, and that's the reason you are seeing that IT is correcting. And we believe that valuation compared to what growth rate these guys are showing, large caps, are still expensive. So you might still see, some correction. A lot of people are feeling that probably Infosys, TCS valuations are great, or probably, these are great levels to get in, but we don't think so. Now, coming to the mid cap space, a lot of these mid caps, earlier, 5, 6, 7 years before, or maybe more than that, people used to give less multiple than large cap names. Why? Because mid cap used to get less multiples and large cap used to get higher multiples. Now, because of so much money coming into mid cap and small cap fund, people have started justifying that we are giving mid caps, and not just in IT, but in most of the sectors, we are giving mid caps more PE multiple because the growth rate is much higher. Now, your Persistence, Coforge kind of companies were enjoying multiples of upwards of 35, 40. Now, why they were enjoying? Because their growth rate was not 3% or 5%. Their growth rate was 15, 20% plus. So you mentioned that despite Persistence coming out with 8% earnings growth and Coforge coming out with 3 to 5% earnings growth, stocks are still correcting. Why? Because what market has factored in is higher double-digit growth. So even if at 8%, you are very expensive. And I believe that correction in mid-cap IT is not done. 20% growth rate in such kind of market scenario where, there is global instability, where there is, signs of slowdown, is very unlikely to come, and you would see more correction in IT names. So I would still suggest investors to shy away from IT because there's still downside left in IT.
Okay, that's about IT. Of course, still downside left, and of course, mid-cap IT companies held the promise of a double-digit growth, but they have, of course, reported in single digits, and that's why correction is bound to happen. But of course, you are bullish on the banking sector, right? But what's the tactical call here? Because barring ICICI and HDFC, earnings have been fairly disappointing for banks as well. And margin pressure is expected, in the wake of rate cuts. So tactically, how are you viewing banks now?
So tactically, when I mentioned that, beginning of May, we mentioned that buy Bank Nifty and sell Nifty IT, that didn't make us super bullish on Bank Nifty. What I meant to say over there is that Nifty IT is going to fall and would fall much more than probably Bank. And that would easily give any large cap fund manager or a flexi cap fund manager an outperformance if they would have gone underweight IT or equal weight or overweight on Bank Nifty, and it panned out. Now, what has happened, barring ICICI Bank in large cap names, and if I have to talk about banking in isolation in totality and not on relative basis. So, barring ICICI Bank and Karur Vysya Bank from mid-cap space, the names which we are covering, most of the banks have increased their provisions. Earlier, Nandita, there were signs of stress in MFI, and we saw what happened to some of the NBFCs and some of the small banks. They have gone through a lot. Now, the stress is coming from MSME space. And some of the big lenders have come out and mentioned that they are seeing, stress emanating from MSME space. Now, this has led to higher provisions and, can lead to higher NPAs as well. So banking in absolute terms may go through some pain. But the best part of banks at this point of time is they are not very, very expensive, Nandita. So even if there is some stress emanating in balance sheet, we are not expecting major correction. At best, banking sector would be market performer. So here you have to pick and choose that what exactly you're liking, where the numbers, in fact, more than growth, I think banks where asset quality is not an issue or where the deterioration in asset quality is the least. Those are the spaces where probably, people, because see, everybody is not going to get into defensive space. 100% of portfolio is not going to get into defensive space. Maybe, FMCG, some allocation would increase, but people will remain in banks. So you need to understand the psyche of fund managers. So they will start to position themselves or they'll start moving their money more from stressful balance sheets to balance sheets which are not that stressful. So you will see names like ICICI Bank, Karur Vysya, from our coverage I'm talking about. These names where asset quality is not an issue, these are the places where people will hide, or probably they'll see the growth would come from there rather than banks where the stress is there. So I would suggest be equal weight, and in such kind of times, it is better to be in large cap names rather than mid caps.
Okay. Stick to the leaders, perhaps that's the message from Siddarth. But Siddarth, before we move away from IT and banks, I want to also touch upon, something that has been grabbing headlines. Of course, TCS said to lay off 2% of its workforce. Now, do you see this as a start of a broader trend? How are you viewing this particular news piece?
See, it is part and parcel of any journey of a company. See, we need to recall what happened after COVID. The kind of hiring the IT companies did, also the kind of salary increments which IT sector saw was unparalleled. In fact, any other sector didn't grow as much as IT. And now with whether you blame it to AI, whether you blame it to geopolitics or slowdown at large, we are not seeing business coming in a great pace or the pace it used to come in IT. So that, and IT raw material are people. So if I am not having that much of finished good, why would I store raw material? So it is obvious. We have seen this is not first time that IT companies or any companies laying off. And maybe after 2 years, 3 years, same companies, or maybe after few quarters, same companies would show a lot of hiring also. Yes, we get these inputs, and we can term that it can be start of certain thing which would probably lead to slowdown, and I don't deny that. But making it a very big issue, I think that will not be fair towards IT companies, and I see it as just the way if you look from 5 years, 10 years perspective, this is business as usual for IT companies, and maybe from a shorter term perspective, this can also lead to some slowdown from economic point of view, because other companies might also do the same because nobody is growing. So yes, it is start of or it is not just start, it is continuation, because there were companies who did this before, Nandita, before TCS. So we might see this might continue for some time, but this will not make or break IT companies. This will not make or break economy at large.
Okay, that's the view. But, how are you viewing pharma then in that case? Because, we are still awaiting clarity when it comes to tariffs. And, just a few days ago, we heard that Donald Trump has threatened big pharma in US also to bring down costs. Is pharma a complete avoid?
No, honestly, we don't have coverage on pharma. My understanding on pharma is also not that great. But one thing I want to say to your viewers is that if US want to hurt us in terms of tariffs, then it will hurt where we are supplying things more, whether in form of services or whether in form of goods. And there are only two sectors which contribute bulk of our services to US: IT and pharma. India is considered as world pharmacy. India is also considered as one of the best in IT. And if US want to hurt, obviously they will, try to hurt there rather than, talking about manufacturing or auto, where the component of our exports, whether it in form of services or in form of products, very less. So it was given that if tariff war happens, then two sectors which would suffer most logically would be pharma and IT. And I think viewers know that now Donald Trump is interacting with pharma companies to reduce prices. I think sentimentally it would be negative for pharma. It won't be too, I don't think so. It would lead to a very big correction in pharma. But as I mentioned, since we don't track it very closely, I won't be able to contribute much in terms of names or how valuations are looking.
Fair point, Sid. But the last couple of questions, and looking at numbers from some of these consumption giants, like HUL, ITC, etc. What is your sense? Is urban consumption making a comeback? Because HUL did see a volume-led recovery gaining traction. ITC, although, has seen a mixed quarter. But do you think consumption, which has seen some bit of buying in the last few weeks, would emerge as a dark horse in these uncertain times?
Yes, and we are very bullish, and it's not just now, Nanda. We came out with the report on paint space late last year. We went wrong there for a couple of months, but then we have been very actively recommending that space. FMCG also, we are very optimistic. Just 2 quarters back, we were talking about urban slowdown. Not even 2 quarters back, less than that. Now we are talking about urban uptick in consumption. My point over here is that firstly, people need to understand the growth in FMCG is not very significant always. In best of times, you'll see 6-7% growth, 8% growth. In worst of times, you'll probably see a degrowth of 1% here and there. What we have seen last 2 quarters, that there was very low growth after considerable period of no growth. Now, this quarter, what we have seen, as you rightly pointed out, HUL has shown 5% of both sales and around 5.4% of volume growth. Margins have not been that great, but that is how FMCG works. At first, you will see volume and sales growth, and later you will see the growth or your margin, EBITDA margins also improving. Now, because last 2 years, this sector has been neglected, valuations are very attractive, and we are now seeing growth coming back. Plus, most of the fund managers are underweight on FMCG because they were chasing growth and were more in banks, defense, power, and whatnot. So we are expecting reallocation in FMCG happening. In fact, it has already started, and that's the reason you are seeing these stocks doing well. So growth is going to come, margins overall is going to improve, valuations are attractive. And mind you, when markets are uncertain, money managers hide in defensive spaces. And traditionally, defensive spaces are FMCG, IT, and pharma. IT, we spoke that, things are not looking good. Pharma, we spoke that, there is an issue. So FMCG is the only space where everything is falling in place. The growth is coming back, valuations are attractive, and it's a defensive space. So imagine the kind of money which is going to flow in FMCG stocks in next couple of months or a quarter. So even at these levels where they have bounced back in last 1-2 months, I feel they are attractive investment proposition from 2-3 quarters, or tactically you can place your bets in FMCG from 2 to 3 quarters perspective.
Okay, that's the view on FMCG. Last question really, Siddarth. Any contra calls, looking at the numbers that have come thus far, any contra calls from your end?
Contra calls will be more on the short side, but that, I would refrain from commenting right now. We are not very optimistic on market. We are not expecting a bear market to come, Nandita. So generally, people jump to conclusion that if you're not bullish, that means you're bearish, and you're too bearish, probably you're expecting market to correct significantly. No. What we are saying is that this time consolidation, which we have seen since last 1 year, that is going to continue. And if the patience of mutual fund investors, go by, and if some redemption start, then probably there can be some correction in high growth names which are not showing growth, and that is where we need to not be there. So some of these sectors would be probably capital goods, defense, where there's the gap between the valuation, the gap between the capacity and execution, and what market is perceiving is way too high, and that would normalize. So these are the spaces where one should be very cautious.
Okay, so tell me one thing, what could be a fair return expectation for the year 2025? Investors were over the last couple of years getting comfortable with 20 to 25% return. I'm talking about the same level that the same level of tariffs, but of course that has to be tempered down. So how much would you temper it down by?
And then if you look at CY or FY25, the returns are not there. I mean, the fixed income return would be higher than the equity return, but that doesn't mean that you just see benchmark and then decide that probably I should be in fixed income and not in equity. That's an asset allocation call, which is determined by your risk appetite also. What I'm saying is that we might still continue to be in this zone where markets are going up, coming down, sectoral changes are happening. It is how beautifully you manage your funds. So last many years, people talk about, let's invest in passive funds because passive funds are giving you returns which are in line with index, and active fund managers are not able to beat the index. I am saying that for next 1 year, you should be more in active funds, because if you find a fund manager who's doing great job, it is very easy to beat index in this such kind of market rather than being in passive fund where your returns are not going to be that great because index is not going to move much. So it is how brilliantly you choose your schemes or your stocks would determine what kind of returns you would be making in next 1 year, Nandita.
Okay, that's the view. I have like a whole lot of other questions, but of course we can't really accommodate it today. So Sid, I'm looking forward to our next conversation as well, where I will ask you all the questions that I have today and maybe add a few more depending on the evolving situation. But with that, I would like to thank you for taking out time and sharing your thoughts with us. Always a pleasure, chatting with you. Of course, I wish you a great week ahead.
Thanks, Nandita. Always pleasure to be on your show and express my opinion. Thank you so much.
Well, thank you. Moving on then, looking at the market, we've cooled off from the opening highs. In fact, just around that 24,600 mark, trying to clutch onto it. Let's see whether or not we manage to, end the day at these levels. But if you look at the advance decline ratio, that's completely evened out, although still tilted in favor of gainers. 1:1, that's the NSE advance decline ratio. The mid cap index has also given up most of its opening gains, trimmed its gains, so to say, up just about 0.2% as of now. But just want to point out that the India VIX index has surged past the 12.5 mark. It's up almost 5%, and that's evident because we are seeing some wild moves as well, because we dipped quite a bit, then again we staged some bit of a recovery, a small recovery, still holding on in the green, but it has been or it is turning out to be a fairly volatile Monday for the market. Well, on that note, we've come to the end of this edition of Opening Bell. Thanks a lot for tuning in and staying with us throughout the course of the show. But of course, I'll see you again at 3:30 p.m. with closing bell. So don't forget to tune in. Have a great trading day, and I'll see you soon. Thank you.